everyone, my name is Muskan Arora and I'm a reporter at Markets Group. Today we have with us Elias Bachmann, who is the Director of Private Investments and Senior Portfolio Manager at BSW Wealth Partners. He joined the firm in late 2009 as a Senior Portfolio Manager. In this conversation, he dives deeper into impact investing, red flags in managers, and his contrarian approach when making investment decisions. Elias will also be speaking at our 8th Annual Wealth Forum in Denver on October 29th. Welcome, Elias. With AI gaining popularity and using so much power and water, what kind of strategies and sectors are you looking at to combat the effects of AI?
Yeah, AI it uses a tremendous amount of electricity, and so clearly one of the themes for us is how are we going to produce that electricity to keep up with the demand, and investing in infrastructure, and in particular renewable infrastructure. So we've made some allocations to funds that are addressing renewable power generation, energy storage, just basically fortifying the grid so that it can cope with the ever-increasing demand for kilowatts.
Makes sense. And how will you incorporate AI within your decision-making process?
So at the moment, we do not incorporate AI into our decision-making process. There are some managers that we have used, particularly in the alternative space, that are have been utilizing algorithms and are, adjusting that to incorporate artificial intelligence. But for our decision-making process, we're long-term investors, and at the moment there's no specific use for AI. However, I can see how it will help us in the future, because as we get more used to using AI and the tools become more available for us, taking a lot of unstructured data, which is basically what we do in our research, and structuring it. AI can certainly help on the efficiency front to streamline that process of pulling in all this data, structuring it in a way that you can actually pull some insights for decision-making process. But I don't think that we would actually use it to make the decisions.
All right. Within your private equity sleeve, are you preferring mid-market buyout strategies or secondaries, and why?
So I think we would be more keen on secondaries. The managers that we're looking at right now, they are probably mid to large buyout and secondaries. I think the concern with mid-market and as you go more towards small mid-market is just that they have their size can be a challenge in coping with some of the issues that have come across over the last 3 years, like supply chain disruptions and of course interest rate increases and labor shortages. So that's just harder for a smaller company, generally speaking. The larger companies have better access to capital and can mitigate some of the impacts of higher interest rates as well. So I think if a buyout strategy, probably mid to large. Secondaries are appealing. They're depending on where on the spectrum of private equity you're hunting. I think sort of more on a systemic basis, earlier stage venture and growth funds probably are offering better discounts than more seasoned buyout funds with larger capitalized companies. So we'll see. I mean, there's still a lot of liquidity out there, so you've seen some discounts, but maybe those discounts are there for a really, really good reason. I think we may still be a little ways off from seeing systemically large discounts that are just fat pitches for everybody in every segment of private equity. But perhaps that will materialize at some point. So in the interim, I think somebody playing in the secondaries market just has to be it cannot be a shotgun approach. You have to be very focused on the opportunities, on the sellers, the right sellers, where you can get the best discounts.
Absolutely. And within the space, how do you look for managers? If you could highlight a few red and green flags.
Yeah, I think there are a lot of different approaches to private equity. You can be a co-investor, you can be a direct investor, and I think that there are different strategies, or the way we approach it. We don't think that one is necessarily always better than the other. They have their advantages and disadvantages, but you want to make sure that that manager, if they are a direct investor, that they really do have the chops to get in there, roll up their sleeves, be operators, that their team is deep with operating talent, and that they are capable of shepherding their portfolio companies through whatever the value add business plan is that they're contemplating. On the co-invest side, I guess you want somebody who's more, a team that really has great connections among other private equity managers, perhaps a secondary investor or a fund of, a lot of fund of funds will use those relationships that they have to make co-investments. But even there, like, a good fund to fund manager isn't always a good co-investment manager, because it just takes a lot of like company specific expertise that perhaps a fund to fund manager might not have. So again, you just have to really understand the core competencies of that manager, their team, and how that aligns with the strategy that they're pursuing.
Amazing. So, any particular red flags that, as soon as you see them, you're like, no, I'd rather stay away?
Well, I guess, red flags for me are more on the structural side. So, we invest in a variety of funds across the structuring of private equity funds. So on the very sort of traditional side, you have capital commitment vehicles. And then more recently, and these are not new products, they just have sort of had a rebirth, a renaissance, if you will. And those are interval funds and tender offer funds that can offer interim liquidity. So on a quarterly basis, generally they're offering about 5% liquidity to their investors. So for me, a red flag is when the structure does not match the strategy. So to provide that liquidity, you really need to have a lot of different buckets to go to in order to create liquidity. So if you had, for example, a very focused venture, early stage, venture or growth stage private equity fund, in an interval fund structure, that wouldn't make a lot of sense. And believe it or not, I've actually seen products like that. And I think when investors get spooked, they'll want their money, but the underlying is very illiquid. And especially when investors get spooked, it's usually a tough market environment. And so it probably would be equally tough for those managers to create liquidity among those underlying companies. They'd have to go to the secondary market, sell them at huge discounts. There's likely not going to be a lot of sale exits, that kind of thing. So just really contemplating the entire life cycle of the private equity investment and making sure that that structure matches that. Alternatively, you could see a private equity fund structure that's evergreen, if you will, that has, they have direct investments, they have secondary investments, they have some primary investments, they might even do some debt. And so throughout all of those buckets, there are different pockets of liquidity that they can tap. And they might even have a cash reserve invested in treasuries as well. So I think just making sure that managers are thinking prudently about how they're matching their underlying to the structure that they're choosing.
Amazing. Which sector in sustainable and impact investing are being most affected by interest rates and even elections, and why?
Yeah, so elections, I would say generally they don't have an impact on markets. I mean, the data shows that yes, there could be some volatility, but ultimately, you're not. I don't think there's a winning strategy by selling at some point before an election and buying after the election. Like it doesn't. There's not enough pattern data to suggest that that's actually an actionable strategy. Um, but in sustainable investing, which a lot of it is, in solar, wind, battery storage, electric vehicle charging, those strategies, I think the sentiment right now is really concern if we were to have a more Republican-leaning presidential administration, so a Republican president, and then more weighting towards a Republican Congress. Perhaps that might make it the runway a little cloudier for some of those investments. But a lot of the incentives are already in place with legislation that would really take a lot to overturn. And then the other thing about the concerns that, okay, if we have a more conservative government, then that's going to be unfriendly towards renewable energy. Well, some of the biggest the states where there has been the most investment in renewable energy are actually red states. So, I don't think that governors or Congress people would want to really politically shoot themselves in the foot by kind of killing some of those jobs that have been really a big driver of economic growth for them.
Absolutely. And how do you think interest rates are impacting sustainability and impact investing?
I think it really the stage and the risk profile really matters. So whether or not it's sustainable or impact investing, the further out the pot of gold is from when you are investing your money, the more the current value is impacted by rising interest rates, right? And of course, it cuts both ways. If we have declining interest rates, those investments do really well. So, impact investing and sustainable investing probably is bent towards a larger distance between today and where that pot of gold is, because they're typically more growth-oriented investments. But if you're investing in a solar field or a storage facility, an energy storage facility, those are relatively short distances, and so they might not be as impacted. But then you also have to consider that some of those investments, especially if they're infrastructure investments, you usually use a lot of debt, and debt is more expensive. So, you could see some impact from higher interest rates there. And then on the valuation, cap rates, if interest rates are higher, cap rates are higher. That just impacts all real assets, whether infrastructure, real estate, it doesn't matter, impact or not impact. It's just that's kind of what we're dealing with currently.
Absolutely. Owing to the current market landscape, which sectors and strategies do you think will allow you to gain maximum returns, and which ones won't perform as well?
Yeah, so as to what performs well, I mean, I'm a little bit biased because I oversee our real assets investments here. But we've kind of felt the impact of higher interest rates, right? A lot of values have adjusted. And so I think there's an opportunity to make investments at more attractive values today. And my sense is that interest rates are probably not going to remain this high for that much longer. And so, I think this is a good time to invest. So, for example, multifamily housing, you've got multifamily housing starts, you've got single family housing starts, all of which have kind of fallen off a cliff recently due to higher interest rates. Yet households keep forming, right? So the demand part of the equation marches on. There's a dip in supply. And, we had a big run up in rents, 2 years ago. And, I think we're sort of dealing with that. There was also a lot of supply that came into certain markets, and so we're digesting those things. But rents have stayed very strong in the face of those challenges. And so, looking forward, I think long term, there's some really appealing tailwinds for investing in multifamily. I think there's money to be made there. I think that there's probably be a supply and demand imbalance for some time, and so that's appealing. Another one, the energy production, and particularly renewable energy. Certainly, there are a lot of tailwinds from a legislative standpoint, tax incentives, et cetera. And those, I think will support more investment in renewable energy, as well as just the long-term sort of demand for electricity. And then, what concerns me? I mean, honestly, I being a contrarian, I think there are elements of technology that concern me just because of the valuations. I mean, I think it's like 45% of the year-to-date return on the S&P you can attribute to one stock, and so and it's a technology stock, so that's certainly something that is concerning. There's also the U.S. is at historically high weighting relative to global indices. And so, perhaps there's some opportunity investing in emerging markets. The valuations look very appealing in those markets. There's always been challenges of investing in emerging markets, whether it's transparency, whether it's governance, whatever it is, right? But you cannot deny the fact that many businesses in emerging markets are growing very fast because their populations are growing probably faster than the United States and other developed markets. And the ascent into prosperity is probably more meaningful there than it is in the developed markets. And so consumers in those parts of the world are going to be increasingly empowered to make bigger purchases and make more investments. At least that's the hope. I mean, that way we all have some shared prosperity in this world.
Absolutely. And multiple managers are talking about giving credit. How are you investing to make sure that they're worth the risk? Like, I would love to know what kind of offerings do you find attractive? What's happening there?
Yeah, so it's interesting. There's so much talk about credit, private credit, and it's kind of like it's like the gateway drug for private investments, because you buy it and then the next quarter you're getting income, and it's private. The income's way better than what you're going to get investing in low risk treasuries or low risk corporates. For us, we're kind of a very sort of purist in terms of ingredients. We want our fixed income to really be fixed income. And so part of being fixed means stability, which means you really got to be careful about the kind of risks that you're taking, because if you end up in a 2008 situation, private credit is not going to save you.
Yeah.
Private credit is not going to allow you to rebalance into cheap stocks. High quality bonds are going to let you do that. And then on the other side of the balance, we invest in private equity. We invest in public equity. And so at some intersection between low risk bonds and public equities, you basically get the same ingredient as private credit, the same beta. Somewhere in that intersection, there is a strong similarity. Now, some of our managers who are managing diversified portfolios of private equity sometimes include private credit. The same thing in real estate. Some of our managers will do mezzanine loans and preferred equity, and that's fine. They'll invest in various tranches of CMBSs. So, we would include it, but we don't include it in as its own strategic slice. We allow our real asset managers to identify the best opportunities for that kind of investment, and same thing with private equity.
Absolutely. That's a very interesting answer. Moving on to the next one. How and why do you think Fed rates are impacting fixed income and real assets sleeve? And like which sectors, like you spoke a little bit about multifamily, but why, which sectors do you think are going to face the most impact?
Yeah. So they're all real assets are all going to be levered pretty much. I mean, even core assets, some of our core allocation to real estate, those still have 25 to 35% lever loan to value. Um, I'd say that, from a day-to-day operating standpoint, a core asset that's levered 25 to 35% isn't going to have really any sort of impact from a, oh my gosh, are we going to lose this property kind of risk, right?
Yeah.
Because the debt is so small relative to the total value, and the servicing of that debt is manageable given the net operating income. But in core, and because core is the lower risk part of the
Hmm.
real estate spectrum, when you have an increase in interest rates, because it's low risk, and part of being low risk is that it generates more stable but lower income relative to some of the other strategies further out on the risk curve, it's going to be more impacted by interest rate increases. And so the
Hmm.
valuation of those assets will be impacted by interest rate increases. Um, and when you get out into like the value add space, we're seeing managers out there that have struggled. They put in these business plans to take a 1980s multifamily property in 2021, buy it. Okay, let's dump about $30,000 to $40,000 per unit into this property, and kitchen upgrades, bathrooms, flooring, common area amenities, you name it, right? So it's a Herculean effort to really transform a property from like a B minus to an A minus, right? And the
Yeah.
hope is that you can just jack up the rents to new,
Hmm.
to a new sort of cohort of renters, and that's the business plan. You make more money because you're getting more rent, and it pays for the investment. Well, delays from supply chain, more expensive and unavailable labor. And then, oh my gosh, I had a 3-year loan on this thing, and it was floating rate, and the rate went through the roof, and it's very difficult to service. And now I got to refinance, and I'm not even done my business plan. That's those people are in trouble. And so, but there's a lot of capital out there on the sidelines. I'm sure you've heard of the dry powder, both in private equity and in real assets. That's just kind of
Yeah.
waiting around for these deals to materialize, where there's, all these value adders that are distressed. I think the reality right now is, like, yes, there are some of them, those deals, but they're not as abundant as you would have thought. And there are a couple of reasons. I think one is that there's a lot of capital out there, and sometimes those sponsors are able to rescue those deals with their own
Hmm.
investors. Other times they're able to sell the dream of like picking up this busted deal and making a go of it the second time. And then banks are not really, they don't really want to take over these loans.
Yeah.
They want to see them to a more graceful finish.
Hmm.
And they can probably do that more they're more likely to succeed at that if they stick with the current sponsor, assuming that the current sponsor is not a complete, uh, uh, you know, like they haven't just completely taken their eye off the ball, and they're just a
Hmm.
sort of fly by night operation that's really won't be able to rescue, turn this thing around. So, I think banks are incented to stick in it, and so we just haven't seen those deals as much as we would have thought. Um,
Amazing.
yeah.
Yeah, sounds good. And this is the last question, but in real estate, do you see offices making a comeback?
Well, at some point, maybe there'll be so little new construction of office that we will sort of refill the existing office. I don't know. The genie has really been let out of the bottle with remote work. And, I think in certain markets and with certain companies, there is, a return to the office is underway. You see banks in New York requiring their employees to be in the office 5 days a week, and that's happening. But that's happening at sort of like the core. And you really for office to come back, you really need that to sort of expand out to other markets and other types of businesses. I just think that it's really tough in some businesses that almost are more competitive if they do work remotely. And so, like I said, the genie's out of the bottle, and I think for some of those businesses, there probably will not be a return to the office ever that looks like what it did prior to the pandemic. However, and then what other factors could make office come back? You have the supply of office space will go down. There's going to be some conversions from office space to residential or other uses. And so that'll probably take some square footage off the market. But I think in the interim, it's going to be kind of painful for a lot of office, just because you have a lot of tenants that are nearing the end of their leases. So every year you're going to have leases roll over. And my guess is that most of those tenants are going to renew for less space than they had on their existing lease. And so we're still in it, I think, with respect to office. And, I think there's going to be some reconciliation. Some, with lenders are going to have to actually realize losses on some of these loans and they already have, but I think it's going to be more widespread. And we'll just have to work our way through that. And it's not going to be pretty for those that have a lot of exposure to office. But thankfully, I think we sort of saw the appeal of asset classes like infrastructure and multifamily and industrial, and our managers have been allocating to those type of asset classes much more than to office. And that's not to say that like an office, you can't be successful investing in an office today. I think it just has to be a very specific type of office, very unique space in the right market. And, they're out there, but I'm sure they're pretty hard to identify.
Absolutely. And I think you answered all my questions now, and it was great talking to you. And thank you so much for diving deeper into things. I really, really appreciate that.
Oh, you bet. Well, it was great chatting with you, and look forward to the next time we meet.
Yeah, absolutely.